You know that you can save income tax by investing in various tax saving instruments like NSE, PPF, NPS, insurance, ELSS, ULIP, etc. under Section 80C of the income tax. However, do you know that ELSS is best among all of these options when it comes to both savings and tax and earnings on investment? Welcome to Nana's Learn Better. Use this channel to enrich your knowledge in personal finance to take informed decisions. Do subscribe to the channel if not done already. ELSS or Equity Linked Savings Scheme is a tax saving investment under Section 80C of the Income Tax Act. ELSS funds are a class of mutual funds investing up to 65% of their portfolio in equity instruments of companies. Investing in these funds is an excellent way of creating wealth while saving on income tax. By investing in ELSS mutual funds, you can claim a maximum tax rebate of 1,50,000 a year, thereby saving up to Rs 46,800 every year in taxes. When invested, your investment in these funds has a lock-in period of 3 years. Only after that you can get back the investment. There is no provision to redeem these mutual fund units within the lock-in period even if you are ready to pay a penalty. Okay, but why ELSS is considered as the best among tax saving options? The first and foremost reason is the return on investment. The return from tax saver instruments other than ELSS like PPF, NSE, Senior Citizen Savings Scheme, Tax Saver FD, etc. yield only about 6 to 8%. The only exception is ULIP, in which you can get more than 8%, but even that is nowhere near ELSS because not all the amount collected in ULIPs is invested in income generation, as a part of it goes towards insurance. Clearly, none of these options can match ELSS, which can yield an annual return of 16 to 20% when invested for medium to long term. The second important reason why you should consider ELSS is the shortest lock-in period. Only ELSS has the minimum lock-in period at 3 years among all these tax-saving options. The lock-in period for the rest is, for example, 5 years for ULIP, 15 years for PPF, and it is even higher in the case of Sukanya Samriddhi Yojana, that is SSY, wherein it is 21 years. In National Pension Scheme, NPS, you cannot get anything back before you become 60 years old. The third reason why you should go in for ELSS is the savings on capital gains. Since any investment in ELSS is locked for 3 years, there is no question of realizing short-term capital gains. You can realize only long-term capital gains, and from the long-term capital gains you get up to Rs 1 lakh per year as tax-free, beyond which you need to pay a capital gain tax of 10%. Once you have decided to invest in ELSS, you can invest straight away if you already have an investment account with any of the mutual fund houses. Else, open an investment account with the mutual fund house, then start investing. If you already have a demat account and trading account with any of the brokerage firms like ICICI Direct, Grow for example, then you can straight away invest into that. You can invest either a lump sum in ELSS or you can opt for systematic investment plan. The route of SIP investing in mutual fund, including ELSS, works better than a lump sum investment as you will be able to average out the purchasing cost. My suggestion would be that you select the appropriate ELSS fund, one or more, and set off monthly SIP at the beginning of the financial year. This way, you can distribute the maximum investment of Rs 1.5 lakhs over a period of 12 months. For example, if you plan to invest Rs 1,50,000 in a ELSS fund for the financial year 2023-24, then set up the SIP to start in April 2023 and start investing Rs 12,500 every month. If you plan to invest in 2 such ELSS funds, then do a SIP of Rs 6,250 every month in each of them. Okay, so how to select the right ELSS funds to invest? Look at the historic performance and select a couple of ELSS mutual fund schemes from the lot. Ensure that you select the schemes from different fund houses so as to diversify the risk. You can shortlist the funds either based on the returns from inception or based on the last 5-year returns. What you see here is a sample of such funds yielding very good returns in the medium to long term. On an average, these ELSS funds have given a return of 24% in the last 3 years, 16% in the last 5 years, and 18% since inception. I would recommend that you have an investment horizon of at least 5 years and start investing in ELSS. This way, you will invest for the first 5 years and redeem the amount after 8 years, considering the lock-in period of 3 years for the last tranche invested on the 5th year. By this, you would have contributed a total of Rs 7.5 lakhs in 5 years. Even if we consider that the ELSS funds give you an annual return of only 15% per annum, your investment of Rs 7.5 lakhs would have grown to about Rs 16.83 lakhs at the end of 8 years, a total return of 124%. If you consider the yearly savings and tax at Rs 46,800, then the cumulative yield at the end of 8 years would be about 226%, which is equivalent to 28% per annum. That is, your initial investment would have grown by 3.2 times in 8 years. Okay, but surely there should be some disadvantages with ELSS, right? Of course. Unlike PPF, NSE, tax saver bank FD, etc. that allow you to withdraw prematurely, you cannot withdraw your ELSS investments before the lock-in period of 3 years. Also, since ELSS invests predominantly in equity, there is certainly a risk, especially in the short term. If you are risk averse and want to play safe, then ELSS investment is not for you. You can go ahead with other options like PPF, NSE, etc. for example. But if you are not risk averse and want to save tax and at the same time build your wealth at a decent rate in medium to long term, then ELSS investment is for you. This is all about why you should consider investing in ELSS under Section 80C if you want to save tax and at the same time build wealth in the medium to long term. See you in another video. Till then, this is Narayanan Viraya from the channel Nanas Learn Better.